uh, and this should be about 60 minutes. And it'll be great if people can contribute, respond to surveys, just drop me a chat. So then I'll be able to kind of, it'll tell me that yes, this conversation is engaging and people are kind of taking away some insights from this conversation or from this presentation. So a bit about myself. Nihar, my name is Nihar Maktula, and I'm a certified financial planner or 10 years, for almost 10 years. I have also completed my NISM certification, which is a SEBI and a AMFI requirement for mutual funds and PMS distribution. Uh, Prior to this, I came with about 30 years of experience in hotels, BPO, customer service. Senior roles for 10 years across various domains. I managed a large headcount based out of ASEAN in Malaysia. And I started my financial services journey in 2014, 2015. I completed my certification in CFP. Then I was a practicing financial planner from 2016. I am a CFP both in India and Malaysia. I've advised numerous families on financial planning and investments. I've been conducting seminars regularly for a very long time, and I thought there's a huge opportunity for NRIs specifically on guidance on where to invest in India. Typically, they don't really have. They most of the time your touch points are your relationship managers, with banks, etc. And many a times they don't give. My experience has been that they give you what they want to give. They're not giving you what you really need. So this was, my initiative. I saw a business opportunity, to be precise, of helping NRIs invest. And along with that, I don't only help you invest, but I actually want to look at your goals and do a holistic investment strategy. So here, one is preparing for your retirement corpus. That is one. Second is when you retire, how are you going to manage that money so that it sustains, for 30, 40 years that you're going to live, and most likely it'll also remain as a legacy for your children or anybody else that you want to pass on that legacy to. So that's my whole agenda for starting this business. Uh, having Yeah, and moving on from there. Uh, Today, what I'm going to cover is why retirement planning, uh, social security situation in India, planning for retirement. How do you plan for retirement? How can you create your own pension system from mutual funds? Because all of us want to have. I mean, everybody aspires to have a good pension system, but obviously you cannot do that with a private job. And something to do is protection of your retirement kitty, because once you have your kitty, that is first part. But how do you protect your kitty uh, from any health emergencies? And I see that as an opportunity also. A lot of NRIs typically don't have health insurance, and that could put. So there are two challenges to it. One is that if you buy a health insurance late in life, getting a health cover, comprehensive health cover, could be a challenge. And B is that the cost will be far, far higher with a lot of caveats. So, as we all plan for our dreams. So when we start working, even when we are in our college, we start thinking about what are dreams in our life. So, most of us aspire to have homes, aspire to have families, aspire to gain stuff, or have a good house, have good interiors, would have good stuff, would love to travel, would love to shop. So these are all our dreams, and I think in all these dreams, one dream that really kind of is too far out and which you're not able to see until much later in life is retirement. So I have a quick question over here, from the attendees. Can you tell me, I mean, have you given a thought to your retirement until recently? Just drop me a quick message in chat. When did you think about planning your retirement? Anyone? So I've got mixed responses. Okay, let's move on from here. So planning, and I hope if you haven't planned, it's never too late to start. You may not achieve exactly what you want, but at least knowing where you are, I think that's the best situation to be in, and then you can plan around it. So the reason we need to kind of focus on retirement is that in the past, earning age was early. People did not really study much when we were younger, or a generation before us, 18 years they would start working. Currently, because of our education, because of grads, post grad, etc., people start working late. So instead of working at 18, 20, you start working at 25. Then and then to think about it is that our retirement age has started to reduce. So there are some people who said they can continue working, so which is really lucky, especially if you're in oil and gas based out of Malaysia. That's a great opportunity. But generally I've seen in the corporate world, 50, 55 is when people start to, they don't want to quit, but the work situation and the work life, the pressure of the job is such that they cannot sustain beyond that age. Or the from a cost standpoint, their salaries are so high that it's easier for a company to replace that individual with somebody with a lower experience but with a much lesser pay package. And in terms of work output, it might almost be the same. So that really puts a lot of pressure on individuals, because obviously it's kind of going to put, if you do not progress in life, it's going to be challenging for you to manage or work with younger bosses. It would be bad to see, or you would not be happy to see your colleagues, people who joined with you with the same experience progressing, but you kind of stagnating at a certain point. So every individual's situation is going to be different, but at some point everybody's going to get hit with it. So if not with the progress, it could be with the pressure, work pressure. So, so clearly, earlier people we could work for 40 years. Now I think maybe 25 years. If you're lucky, 30, 35 years is a very small number. So what you got to do, all you have to do is plan within these 25 years. And I know a lot of, I've seen some people, put the age as 55, 49, 39, mid 30s. So your people at various stages. So people who are at late stages, probably you need to kind of identify from here where you are and what you need to do over the next few years to kind of financially secure yourself. And the most important thing is knowing what you want and doing what you need, because that's the starting point. And that's exactly what I do. I help people, in case you do not know what you need and how much you need to collect and how you can manage, then that's my job. I mean, that's my business, to be very honest. And obviously to top it up, life expectancy has gone up, about 65, 20 years ago, now it's about 70. But this is a misnomer, because generally I've seen lifespans, at least most of my family, friends, parents, etc., people living well into the 80s, even with very frail health, because medical facilities are good. We're able to spend that money to take care of our parents. People have been, I mean, easily living past 80, well into the 90s also. So clearly, you will have a situation where we will have expenses that will kind of, our lifespan is going to go up, expenses are going to be higher, but our income or our savings is not going to support it. To make matters worse, earlier we had a joint family, now we are more nuclear. Earlier people had more kids, now the current generation has lesser kids, and kids do not have the same sense of responsibility as we had, or probably the previous generation had, towards the parents. And most likely for a lot of us, our kids will not even be in the country we live in. So if we go back to India, at least I know in my case, I have a son who lives abroad with no plans to come back. So we are in a very peculiar situation as we move forward, becoming very westernized, and hence being financially and health wise independent is going to be the most crucial element to live a good life moving forward. I mean, people, do you agree with what I'm saying? Any thoughts? Yeah, so I can see, I can see people saying yes. People are kind of agreeing to it. So it's very critical, and I will kind of really stress very hard that, this is talking about money, but I think more than money, your health is going to be the most critical piece. At least personally, my aspiration has been that I have to be very, very healthy. At least that's the effort that I have to make. And then what God has in store for me, that's a separate story. But at least personally, I'll make sure that my health sustains till the last day. And then if God decides no, we have to fall sick, we need dependency, then that's a separate story altogether. It's something that we cannot plan for. But at least financially, I'm planned for that. So, we did a quick calculation of what is going to be inflation, how inflation impacts, because that's the biggest challenge that we have in India. If somebody is in the 30s, for people who are in the 30s, currently, if your expense is 75,000 today, then by the time you retire in next 30 years, the expense will almost become 5.7 lakhs. Same, you're going to undertake the same expenses. It's just that it's going to the inflation is going to run at about 6 to 7%. If you're lucky, it might be 6%, but you could end up. This is the kind of inflation graph that you're looking at, the cost escalation. Now let's reverse it around. One is showing you what is cost looking like. Now we have some people who are going to retire very soon, and if you're going to retire now, your expense is probably going to be about a lakh, but at the rate that it's growing, it'll have the same escalation levels. So typically, this will become, by the time you're in your if you're 60 right now, or you're going to be hitting 60 soon, then your expense probably might be about 2 lakhs now. But assuming a 7% inflation, it will become 2x in 10 years, and it will become another 2x, another double in next 20 years. So whatever is 2 lakhs now is going to cost us more to 8 to 10 lakhs by the time you hit the age of 80. So one is in looking at expenses moving forward, when you're working. Second is expenses moving forward when you retire. And what I've seen in retirement is a lot of individuals think they will be spending low, but most of the times what happens is, because you have time, you'll end up doing a lot of activities. You'll end up doing a lot of things, and that will cost money. In today's times, every time you step out of your house, most likely you'll have to spend money to do something. So cost, we might think, might go down on retirement, but in most likely you'll end up spending more money. So it's the requirement is to be better prepared financially as we move forward. And then if you look at declining value of savings, 1 lakh today is going to be worth only 13,000 rupees 30 years down the line. So you have a double whammy of costs going up, and obviously because of which your saving is not going to suffice. So the question is, are you planning enough? So are you planned well enough, for your savings and your expenses? Another factor is healthcare. Do you know what is the healthcare? I have the number here, but I'll just run a poll. What is the healthcare inflation in India? I hope you're able to see the poll. So I have people saying, 7%, 10%, but the reality is 14%. So healthcare inflation is 2x of all the other expenses, general inflation in India. So it's a staggering number. It's a staggering number. And I have a slide, following up a few slides showing some of the challenges with healthcare in India. So, typically because of the inflation, every 14 years means every 5 years, the cost is going to become 2x. So today, in our age, in 50s and 60s, something that will come very, which will might happen is cataract. So cataract costing about a lakh 7 years ago will cost almost 4 lakhs in the next few years. Then, if you are going to undergo any heart surgery today, if the cost today is say 7 lakhs, 5 lakhs, 7 lakhs, in the next 5 years, the cost will double. In the next 10 years, so if you're in your 50s now, when you turn 60, it will probably cost about 10 lakhs. When you become 65, it will probably cost about 20 lakhs. So the question is, do you have enough health cover to factor in those potential costs? Because at the end of the day, if your insurance company or if your insurance is not covering it, then you'll have to pay for it from your own pocket, and that's going to take away from your kitty. And obviously, in India, there is no social security. I mean, there is nothing that the government offers. We only have to pay taxes, and we have to fend for ourselves in our retirement. So the numbers don't look great in for us. As forecast says 19% Indians will be above 60 in the next 20-25 years, and most of the people don't have a retirement plan. Either they don't have one, or they're not capable of saving enough, and they'll have to just depend on their children to sustain. So it's a very scary situation as we move forward. And I just and if I take it back to the family units becoming smaller, most of people having one or two kids. So even for one child to support two parents is not going to be easy. Versus, I'll give my example: three siblings. So between three siblings, we manage our parents both financially, and if we have to be present with them. We live abroad, so we travel just to be around when it's needed. It's easy to rotate, but for one child it might be very difficult. So retirement corpus, these are just, I've given some numbers. What I've done is I've taken current age in this column. So you look at your age group. I've given an assumption of retirement age of 60. I've said, okay, what's your expenses now? So if I take somebody at 45, expense in India is about 1 lakh. Then at 7% inflation, this will become almost 2.75 crores by the time the person retires. And the individual will need about 7 crores of financial assets. Financial assets means that I'm assuming that you are invested in a balanced fund which is generating a 9% return, and inflation is going to be 6%. So the 7 crores will grow at 9%, but your cost of is going to be 275 and will only grow at 6%. So if with this kind of a investment strategy, this fund will last you for 35 years. So it's a good way of it's a good benchmark for people to at least get a fair assessment of where you are. And for specific individual cases, we can take it up separately, one on one. I mean, how do people feel? I mean, do these numbers, are you able to relate to these numbers? Great. So I've got some people saying yes. I've got a few people saying no. And if whoever said yes, are you kind of in line to kind of hit this number or get to this corpus, or you're already there? If you're already there, fantastic. So very, yeah, it's a mixed response. Great. So okay. So if you, I mean, if you're interested, you could just drop me a private chat. I'll reach out to you after the conversation. I have your contact details, so we can have a conversation. On in the coming week to help you set up a strategy. So I think, yeah, and let me get into the next bit is, we say that this is the most expensive financial goal. I think, retirement, we normally say a man's biggest expense is his house, and everything else follows. But I think the retirement is even going to be bigger than the house. Um, Unless, of course, you buy a mansion which will cost 10, 15, 20 crores, then that's a separate story. But otherwise, for most, higher middle class individuals, retirement is the biggest financial goal. And unfortunately, there's no financing that is available. You should plan as if, you're not going to take any money from your children. At least that's my strategy. No money from my son. I will manage everything on my own, and we've got to fund it. So we have a very challenging situation, and the need of the hour is, when we retire, is that we need a monthly cash flow, which is almost like a pension. But at the same time, we also need capital appreciation, because you cannot just have that if my expense is going to be 10 lakhs in, and then every year it increases by say 6%, and I can only take that money out without the fund where I've invested growing, then the corpus is going to be significantly higher if it's not going to give you any returns. And the whole idea is that the returns that you generate from your corpus should be much more higher than you get from than inflation, because then that's going to give you a positive delta which will continue to expand your portfolio. So the strategy is, plan your retirement with mutual funds. And again, I'm stressing the fact that mutual funds could be of the key portion of your portfolio, and you would have fixed assets like FDs, maybe senior citizen savings schemes that could be ancillary assets that could work with the mutual funds. And here I've taken an example of a mutual fund strategy only, uh, and here it goes. So basically, the thought process is that when you have a SIP plus SWP strategy, so when you are working, when you're earning, you do SIP. When you retire, you do systematic withdrawal plan. And I have some examples, that shows how it works. So SIP, I will not talk too much about it, because everybody knows about SIP. I mean, unless somebody wants me to delve into it, just drop me a quick message that should I cover this, or I just move on, because SIP has been advertised enough, has been published enough. It's always there, constantly being reiterated in various forums. But I still have, despite this, I know there are investors who have been investing for a long time and who kind of think that they should stop investing in SIPs when the market goes up, should put in more when the market goes down. But my advice would be that data says that just being consistent and disciplined is the best way to best approach to SIP. Of course, the three golden rules for all investors is: start early, invest regularly, and invest for long term. We've taken a simple example, 25-year-old or 35-year-old and a 40-year-old putting the same amount till the age of 60, and the sheer difference in the outcomes is quite staggering. Somebody at 25 doing 10,000 a month till 60 at a 12% return may end up with about 5.5 crores, and somebody starting 15 years later will not even end up with a crore. So clearly, starting early, investing regularly, staying invested, and staying invested for long term is a fantastic idea. Now, obviously, people, not everybody starts at 25. A lot of people start at 30, 35, 40, and we've got to kind of revisit, how to make that strategy work. Now I'm going to systematic withdrawal plan because uh, taking investing, because the whole idea is to create through SIPs, create your corpus, determine what your goal is, uh, and then once you get to that number and you retire is when your withdrawal starts. So how does SWP work? So before I go there, I have a question. I mean, are you familiar with the systematic withdrawal process? Let me say, I'm just running a poll. So the question is, do you have a well thought out income strategy for retirement? So I've got answers. Somebody thinking, but generally the poll says no. Nobody has a thought through plan for retirement. Okay, so you the strategy would be a mix of, if you have SWP, could be senior citizen saving schemes, could be FDs, and you could use a mix of three. Uh, in this case, I'm only talking about SWP right now. The systematic withdrawal plan is, you have assuming that you have an opening balance of 1 crore, that is 1 lakh unit of rupees 100 each. Uh, you decide for the year, you decide to take out 5 lakh rupees. So that means it will take away 5% of your corpus will go away and 500 units will be withdrawn. That will leave the balance, which is 95 lakhs slash 95,000 units, because that's the price. 95,000 units into 100 is 95 lakhs. These units will continue to stay invested and will grow. In some years, when the markets fall, there could be a drop in value also. But if you give it like a consistent period of time, then you'll see the value continue to go up. So it will not be linear 12%, but if you look at a 5-year rolling, it will be 12%. So you could consider. So this is how SWP works. You invest in a mutual fund scheme when you're earning, create the corpus, and then you have two choices. Either you take out and put in a balance fund, but then there'll be a tax implication. Second could be that you keep your money in the same fund and just keep on withdrawing it. And this could be a mix of funds. It could be not just one fund, it could be a large cap, mid cap, small cap, flexi cap. It could be a mix. And the strategy of how to, should we kind of keep in the same fund, should we move to another fund, can be decided with a financial advisor. So if you're investing through me, then that's what I do for my clients. Depending on the market situation, client risk profile, I decide whether the money should stay somewhere or should we take it out and reallocate somewhere else. And then that is how we will continue to withdraw over a period of time for the next 20, 30 years. The good part of SIP is, or SWP, is that it allows you regular withdrawal. There are no limits. There is total flexibility. You can withdraw each month. You can withdraw every day. You can withdraw every quarter. You can withdraw for 3 years and set aside and let the remaining money remain to compound. So it gives you total flexibility. Unlike a bank FD, where you cannot take out the money, or a senior citizen saving scheme where your money is locked away for 5 years. You can only get interest, or if you withdraw, you'll end up paying a penalty. So the good part of SWP from a mutual fund is that it's totally flexible. The only issue with it is that it's volatile, because it's linked to the stock market, uh, and hence you could see price, the value go up sometime, the value go down sometime. If there is a massive drop in the stock market, the value go down significantly. So that's the biggest drawdown, or the negative of SWP from a mutual fund, but it gives you total flexibility. But if you are planned for say 3 years, for example, if the market goes up to 85, 86 and you are retired, you might as well withdraw money for 3 years because you don't know what's going to happen in the next 3 years. Take out money for 3 years and let the remaining money compound. This money you can put into a liquid fund, which is safer. 6% is 5 to 6% is what you'll make, but you have the money available for 3 years. The rest continues to compound. So here I'm taking a case study, of an individual, and excuse me if people, I know there are older people also in this group, but I'm taking a case of an individual about 30 years old, starts with a SIP of 25,000, increases by 10% every year. The retirement age for this individual is about 55. Return I'm assuming is 12%, and the corpus target for is 10 crores. Now, at this age, this person starts off, with a SIP. So age is 30, retirement goal is 55, um, and starts off with a monthly investment of 25,000. Now, case one is flat, no increase in their monthly SIP. The individual will invest 75 lakhs over 25 years, and the value at the end of 25 years is going to be about 4.75 crores. This obviously is not going to be sufficient because the goal is 10 crores. Another way to do this is start off with a 10% annual increase. So 25,000 at the age of 30. So for 12 months, and every year continue increasing it by 10%. And that simple strategy will get this individual to a 10 and a half, almost 10.25 crores corpus in 25 years. So I think a step up strategy is the best strategy to use, especially, it allows you to kind of increase your savings as your income grows, and it helps you get to a significantly large corpus. The case three is that if somebody had to get to this number at with a flat investment, then the investment amount would have always been 58, which for many individuals at the age of 30 may not be a feasible number. So a good strategy to use is, do a 10% annual increase, max out your investment that you can do each month, and then increase it by 10%, or at least peg it to your annual increment. So annual step up SIP is an excellent strategy to create large corpus. So I also have, I have certain individuals who are in the mid 50s. So I was consulting a client, again, oil and gas, is about 58 years old last year. So he'll be 59 now, but he still knows he's got about 7-8 years that he can work over here. And he started off with a SIP because he had a corpus, but he wanted to create a larger corpus. And we thought, how can we create a SIP strategy where you invest your current expenses worth every month, leave it for 5 to 7 years, and then take it out, to take care of your. So that's a cycle that which will start say at the age of 65. So that will sustain him from the age of 65 until probably 75, because the money is going to compound at 12%. His expenses are going to compound at 6%. So that's going to be an amount that's going to help him tide over another 10 to 15 years. Now, I'm coming to the monthly withdrawal through SWP. Quick question, let me know if I'm kind of, I'm going, if I need to slow down, or if I need to explain something, then please just drop me a message. I'll be happy to kind of, stay put. I can revisit. So if somebody has a retirement corpus of 10 years and assuming that it's in a balanced fund, the return will be about 9%. The expense of this individual that we spoke about will be about 4 lakhs each month when the person retires. The inflation is assumed at 6%, and in year 2, it'll go up to 4.24 lakhs per month. This I'm talking about per month. So I have an Excel file. It kind of just gives you an indication of what these numbers look like. Give me a moment. So I took this example of this individual, at 30 right now, retiring at 55 and getting to corpus of 10 CR. Now, if you look at this corpus is growing at 9%. His annual expenses are about 4 lakhs in retirement. So about 48 lakhs annually. Now, what will happen is from this 10.8 CR, he'll take away 48 crores. The remaining amount, grows at about 9%. And so effectively at the end of 2050, at the beginning of 2051, this amount will actually be 11.21 CR even after taking out 48 lakhs. And the next year, the amount goes up by 6%. From 48 lakhs, it becomes about 51.7 lakhs. So here you take away from 11.21 CR, take away 51 lakhs, and it grows at about 9%, gets to 11.62. So if you see this in this fashion, this individual is able to sustain himself for 30, 31 years. So of course this is not going to be linear. Your expenses are going to be linear, but your returns are not going to be linear. So there could be, but at least if you kind of average out to 9%, this is how it looks. So if you want, I'll be happy to share this. I'll be happy to share this Excel file and the presentation also. You just drop me a message and I can do that. So effectively, somebody is able to create their own pension system by investing 25,000 at the age of 30, and and start taking out money when they get to 55. Similarly, irrespective of your age, you can start investing even now. We can consider reallocating your investments to optimize returns and see how you're able to kind of get to that corpus for retirement. The good part is this is a tax efficient approach, because any other savings, whether it is except for senior citizen savings scheme, which is tax free, but the limit is only 30 lakhs. But if you take FDs, if you take corporate FDs, all of them, the capital gains is based on your income. So it's not very tax efficient. Here, it is very tax efficient because you only pay capital gains 12.5% on profit. So if you withdraw 1 lakh and if your profit is 40,000 out of it, then you're only paying 12.5% on 40,000, not on the whole 1 lakh. Uh, Hybrid category funds, typically if you choose to take the hybrid route, then it's the good part is that it's balanced. It has debt and equity. uh, it is a steady income. Historically, hybrid funds have delivered about 12 to 14% over the last 10, 15, 20 years. So the good part of hybrid funds is that it's invested across debt and equities. It's tax efficient. Like withdrawals, very, very flexible. And there is volatility cushion because debt of 35 to 40% in that portfolio ensures that you do not see such the downsides in a market. Downside market will not be huge. It'll be far more curtailed. So in a nutshell, I think planning for your own retirement is the most crucial financial goal. Starting early is the key, and I think what is critical is to create your own pension like system. So basically SIP and SWP. Think that's going to be the most crucial way of managing it. Quick question: are you able to see my screen? Okay, now I have started sharing. I don't know, for some reason it's yes. Okay, great. A quick question over here. Would you like to adopt a pension-like income strategy for retirement? So I'm 100%. Yeah, most everybody's saying yes, they would. So next question from here. Do you? I mean, do you want me to work on your investment return strategy? It's good. I'm seeing 100% say yes, but it'll be good if you can just drop me a one-on-one privately also. So then I can reach out, to you individually as well. Okay. Fine. So I think thanks team. Yeah, thanks. Appreciate people. I've got quite a few people who are interested, so I'll reach out to you separately later today, or through the week. So this is about SWP. Now something that I think is very critical is health insurance. Uh, so my question is, have you planned to protect your retirement corpus? So if you know if anybody can tell me yes, no, if you can just drop that message in a chat if you have planned for your retirement. I mean, have you got enough in health insurance for yourself? There is people. Earlier, we used to think like 15 lakh, 20 lakhs is enough for health insurance. I have some numbers separately, but my approach would be, that you should go for like a big ticket health cover, say a 1 crore, 2 crores, 3 crores health cover. And if you're kind of living abroad, as I see a lot of your NRIs, your children are abroad, then you could probably even, there are also options to take an international health cover. Typically, an Indian insurance company will give you international health cover, but it'll have most of them will have a 2-year waiting where they will not admit international claims. But then after 2 years, they'll allow international claims. And obviously, if it's an international claim, then 10 lakhs, 20 lakhs will not suffice. You need at least something that's, at least 1 crore. I would personally say maybe about 2 to 3 crores. And the premium amounts are not hugely different. So if you're interested, reach out to me. I could kind of, help you get that also. Because I'll give a simple example. I have a personal, I just signed up for a health cover with ICICI Lombard. It cost me about 78,000 or 80,000 uh, for 3 crores for me and my wife. So the cost is not huge. Yeah, surprisingly, it's low cost, especially for NRIs. The cost is lower versus people living in the country. So, so it'll be a good idea to take a big ticket cover because the expense are just insane. So it's better to kind of take that cost every year and have a significantly good cover versus having to pay from your pocket. So so health insurance, as we said earlier, we discussed 14% is the health inflation. That means every 5 years the cost is doubling. 4x in 10 years, 16x in 20 years. So if you're 50 right now, and if the expense today is 5 lakhs, by the time you are 70, it's going to be 80 lakhs. So it is going to be significantly higher. It can puts a lot of families uh, to zero on their savings or denting finances significantly. Uh, the health insurance cost is just about 1 to 3% of the insured amount for lower ages. Even for higher ages, it's not significantly bad. And it is important that you try and get a cover as soon as possible, the at a lower age, because your health condition is better, the premiums are lower, you will not have any exclusions, because most of the things I've seen through a lot of clients and otherwise, once you get to 45 and upwards, any cover then becomes a challenge, whether it's a life cover or whether it's a health cover. How much health cover? I mean, there are two rules to determine your health cover. One way is, your sum insured should be 50% of your annual income. Uh, that's a very straightforward calculation. The second should be that if you are going to do a coronary artery bypass, an expensive treatment, and you want to do it at a preferred hospital back in India. So, say, assuming that you are from Bombay, you want to do it at a Jaslok hospital, or if you're in Delhi, you want to do it at Max or somewhere. What is going to be that cost? So you should at least have that much cover for yourself. I've just picked up this chart, from Policy Bazaar, which says in tier one, individuals should have about 10 lakhs, family floater 30 lakhs, senior citizen 20 lakhs, um, and tier two, tier three, assuming that everybody is going to live in tier one or tier two. But this amount I can tell you is very, very low. This amount will get spent in no time if there is a serious illness, because personal experience, I had my father was admitted in one of the listed hospitals in Thane in Bombay about a year and a half back, and he was in ICU for 2 days. We took him out, and of course he was discharged in 3 days' time. But I think the bill was upwards of 1.5 lakh rupees just because of ICU. So if you have to go to a corporate hospital, then the cost of ICU and then related expenses continue to go up significantly. So I think this amount, will not be sufficient for serious illnesses. So I mean, are you able to relate to these numbers? So Let me now, no, I'll take the, this is now the final part of this presentation, and that is going to be, uh, I think the most critical one is plan to stay gainfully engaged, because having the money is one thing, but if you're not gainfully engaged, then it's going to start impacting um, your. I mean, and some, for all of us, we've been working in the corporate world. If one fine morning, we go to the office, it's our last day, and next morning we get up, we don't know what to do. You could have plans to travel, you could have plans to, go for your morning walks, a lot of things. But if you do not have something that's intellectually stimulating or something to look forward to every day, it may become a boon, it might become a bane. So uh, I picked up some stuff, based on personal experiences and looking at reading through some things. So obviously, if you're not engaged, cognitive health takes a beating. So your brain, you need to keep your brain active. So ensure that mentally you remain sharp. uh, your emotional well-being, because if you have a purposeful day every day, then you have a structure, you have a meaning to life. At least personally, I feel if I don't have a meaning to life, I would have nothing to look forward to every day. The good part is also gives you financial flexibility. So if you're able to identify a skill that you can either leverage that you have, or think of developing a skill that you can leverage. So I'll give my example. I come from a hotel background. I got into BPOs, worked in BPOs for 30 years, hotels for 20 years in BPOs, 10 years in hotels. But along the way, I thought, investments, financial planning, numbers are my passion. And I decided 10 years back that, I want to, in 2014, 13, 14, I decided that this is something I want to pursue once I get to my 50s. I want to quit my full-time job, do some, because this is something that will keep me engaged for my whole life. So that's how here I am talking, trying to give some gyan based on what I thought I could do well 12, 15 years ago. And you can also look at legacy building, so sharing expertise through your mentoring, teaching, writing. So it allows you to kind of impact lives positively. And how to plan for it, as I clarify your purpose, like I was able to do that. My example, if it allows, I know a lot of you are from oil and gas, and it allows you to work till 65 and even beyond, then you should continue exploring the opportunity to continue working, because it gives you an active income, it gives you something that keeps you engaged mentally every day. uh, and if you have to pick up something else, then you look at your skills and interest, see what is required. You got to invest in learning. So if you identify a skill but you don't have it, then you'll have to figure out a process to acquire that skill, acquire a skill that gives you the capability to make money out of it. You could also look at impacting, so communities, social, the social ecosystem. And most importantly, yes, plan for it financially also. So you could look at, I can make so much money from my retirement, maybe a little bit this more I can pick up from my side income or from work that I do. So that kind of helps you with an additional source of income, more flexibility. So a quick poll over here, so have you thought of, this is a question for everyone, have you thought of leveraging developing skills to generate income in retirement? This is the last slide, so I'm not going to talk anything after this. It's good. So a lot of people are saying yes, 100% yes. Awesome. So at least that solves for your retirement purpose, or your retirement uh, planning for a fair number of years, if not through your entire lifetime. Great. So I think this brings me to the end of my session. Uh, I'll be happy to take any questions. And sorry, for some reason, my camera is stuck. I'm not able to. The camera is not capturing me. I'm sitting in front of the camera. It shows me it's on, but it's not on. So I'll be happy to take on any questions. You can ask questions either through the chat, or you can